United Spirits sees revenue growth on the back of price hikes, but margin disappoints as input costs rise. Management commentary weak as well. The stock down 5%.
TVS Motor reports healthy quarter with a beat on revenue and records margins of over 10% for the fifth straight quarter. Also lays out a plan to expand its EV portfolio. The street likes it. Stock up 3%.
Pidilite's third quarter misses street expectations on all fronts. Volume growth comes in at just 1% versus projections of 3 to 4%. The company, however, remains optimistic on demand in the future. Stock down 3%.
Nazara Technologies surges after a strong quarter, reports revenue growth of nearly around 70% on a year-on-year basis. Som Distillery stages a turnaround in the third quarter, reports a profit of 11 crore that compares with a loss in the corresponding quarter.
Tattvachintan Pharma corrects after margin contracts in a weak quarter. Quick Heal 2 is lower after reporting a loss in the third quarter.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me as always is Mangala Malu. Well, we have earnings, Mangala, that are coming thick and fast. So let's get straight to our first management. We're joined by the management of Triveni Engineering, who joins us on the show. The margins remain a little bit under pressure, though the top line growth look quite good, and they're also adding capacity. Roughly around 190 crores is what they're looking to spend on that. We have Mr. Tarun Sanai, the Vice Chairman as well as Managing Director, who joins in. Hi, Tarun. Thanks so much for joining in. Well, revenue growth is very, very strong, right? But margins, they're a little under the weather. What's the outlook in terms of margins? When do you expect it to stabilize?
Well, good morning to you. I think we've reported very healthy Q3 numbers with margin expansion across pretty much all the verticals of the business. The only vertical which was slightly subdued was actually sugar. And we expect that will rebound in quarter four when we have more of the export revenues coming back in. As you mentioned, the top line grew quite well, and this was on account of all the businesses pretty much firing. We had larger quantums of sugar sales, stronger growth in ethanol sales from our distilleries, and the engineering businesses of water and power transmission also grew quite substantially. I think all pointing towards very robust demand from various economic sectors.
You said margins will improve by the fourth quarter. What levels do they come back to? Because currently they're about 13%. 18% was what you did same time last year. All of last year was around 15%. So do you see 15% coming back by the fourth quarter?
I think that's a very tough question to answer. Well, the hope, of course, is that we see some improvement in sugar prices, which have remained subdued. So my expectation is that as the course of the season continues, we will see sugar prices rise slightly, and we will hopefully be able to see the kind of margins overall for the company that we saw last year. One must remember that our margins are, of course, a composite of a variety of different businesses, which is quite important.
Okay, all right. Tarun, I wanted to ask you about the other business. You briefly spoke about the distillery business. Now, the volumes have been quite strong out there as well. What's the targeted volume number we're looking at from this business, say in FY23? And also, as of now, it contributes, I think, close to around 33% of sales. That compares with around, the mid-20s. What's the target going ahead on the distillery part of your business?
So, excellent question. I mean, we're at a run rate of about 17 crores litres for this year. We're looking to increase that to about 21 crore litres for the next fiscal year. So that's a pretty reasonable growth, where all the distilleries that were commissioned during at the beginning of this fiscal year, they will be on stream, and of course next year they'll be operating at 100% capacity. So we're looking at a small improvement, of course, in terms of overall contribution. However, I would like to point out that there is growth happening across the various other businesses, engineering and sugar. And so from an overall perspective, I would imagine that the distillery business would continue to represent the same quantum of our revenues.
All right. And you said that there is some capex plan that you have as well. There will be 2 capacities coming on in the second half of the next fiscal. What does that take your overall capacity to?
So we've got 2 capexes that the board considered at its meeting yesterday. We're doing a capex of 90 crores within our sugar business, which is looking primarily at cost optimization and the conversion of one of our factories into a refinery, where the vast majority of sugar that's being produced will be refined sugar, which is sold at a premium to regular sugar. The cost optimization initiatives are really to look at margin expansion versus just top line. So it's more of a bottom line focused to ensure continued profitability. However, there is also a 100 crore capex within our power transmission business, and that is to increase the business's capacity, which is capped right now at about 250 crores of product revenue to about 400 crores. And I anticipate that capex will certainly be complete in the next fiscal year.
And on the distillery vertical itself, at full capacity, what is the revenue potential of this business?
So it's about 10% higher than where we are today. However, I would like to mention that in the last meeting, the board has announced another expansion of our distilleries, and that, of course, is slightly dated news. It's 3 months old. At an expense of 460 crores, we are enhancing our capacity by an additional 450 crores. So 2 new dual feed distilleries of 225 KLPD each. Now that will enhance our capacity from its present 660 KLPD to 1110 KLPD. And I anticipate that will be complete in Q4 of fiscal 24. So say 12 to 13 months from today. That, of course, will lead to a substantial increase in terms of revenues from our distillery business, a growth of at least 70 to 75%.
Okay, all right. Tarun, just to get the numbers correct, for this year, distillery volumes will be around 17 crore, right? 17 crore liters.
Correct.
Next year goes to around 21 crores.
That is correct.
And in the following year, given that you'll have capacity fully on stream, what does it go to?
So we would like to see that capacity when it's fully on stream to go up north of 32 crore liters.
So from everything that you're saying right now, it looks like, Triveni Engineering is more of a FY25 story, because next year you will have some capacity coming in, to improve the back end of your sugar business. Then your power capacity increases substantially. By the fourth quarter, your distillery capacity comes on board as well. So FY25 and FY26 is where one should see the most amount of benefits, right? I mean, could you give us a sense of what sort of margin expansion would entail because of the cost-cutting efforts and the capex that you're putting in, additional revenues coming in? What does the revenue mix of the company look like then at full capacity?
Excellent question. So I think at full capacity, we will see our engineering businesses, which account for about 10% of our revenues, increase to at least about 15% of our overall revenues, despite the expansion in sugar and in our distillery business. But the quantum between sugar and distillery will change quite substantially. Right now, it is 80-20, and we're looking at about 70-30 within that mix after about 2 years. The important point on the margin side that requires mention is on the engineering businesses, we don't see any margin dilution. The margins are pretty healthy, and we expect that they will be maintained with the revenue growth that is anticipated. On the sugar and ethanol side, this is dependent, of course, on government policy, which has been extremely supportive thus far. So I don't necessarily see margins to come under any pressure in the long term, because the government is keen on ensuring the success of the EBP program. And right now, we're only at the stage. At 10% blending, we're halfway there. So there's a lot of excitement, frankly speaking, in this sector.
Very quickly, Tarun, tell us, what about how's your balance sheet looking? You have some capex plans, as you've mentioned, 200 crores odd. So what's your balance sheet looking like in terms of the financials, the debt, the cash in the books? And also, I think you'll have some surplus funds that have come from the cleaning out of the group structure. So how do things stand?
Correct. Our balance sheet looks very healthy at this particular point in time. Total debt is certainly down, and we're going to be using internal accruals for all of this capex. Our average cost of debt is below 5%, which includes a reasonable quantum of loans that have interest subvention. So, very healthy position thus far. And I do think we have a buyback that has been announced as well. And so once all of that is clear, the ratios will improve considerably, and they're pretty good right now as well.
All right. Thanks a lot, Mr. Sawhney, for joining in and giving us the outlook on the business. That looks rosy, though we will wait for the performance and the execution of the same and speak to you every quarter as well. Thank you for joining in. So that was the management of Triveni Engineering. Meanwhile, just keep an eye out on the market. A near 200-point decline is what we're seeing on the Nifty, virtually at the low point of trade. We were hoping for some support to come by between 18,000 and 18,050. That hasn't happened. In fact, a decline below the 20-day moving average has opened the floodgates. Now the Nifty is at the low point of trade with a 700-point decline that we're seeing on the Nifty Bank as well. Let's see where we go from here right now. But in a market like this, let's get you some ideas for profit coming in from our colleagues at Money Control Pro. Jitendra Gupta joins in with a stock.
Hi, thanks. I think the budget is around, and among the opportunities, defense stocks offer very good opportunity. We like Bharat Electronics, which has corrected from about rupees 115 in September last year to currently 100 rupees a share. It is trading at 20 times its fiscal 24 estimated earnings and offering a dividend yield of close to 5%, which is quite reasonable considering, of course, the cash in the books, superior return ratios, uptick in business, and strong order book and earning visibility. BEL has been a big beneficiary of government indigenization programs. Its order book at currently at around 55,000 crore, or close to 4 times its revenue, provides a very good revenue visibility for the next few years. Order pipeline is quite strong. Many large projects post the COVID late stage were delayed, and now it is expected that these projects will be finalized or awarded very soon. Moreover, business is improving gradually with the higher execution in September quarter. If you see, the company delivered close to 26% quarter-on-quarter growth in revenue. Apart from core business, it is also focusing on exports, entering clean energy space, which will show good results in the next few quarters. Overall, I would say the stock provides very good earning visibility, strong order book valuations, along with dividend yield of close to 4%. I think it offers a great value.
Thanks a lot for that, Jitendra. For the time being, we'll slip into a short break. On the other side, we'll be joined by the management of Gateway District Parks. Stay with us.
Welcome back. It is earnings season, so we have another management joining in. It is Gateway District Parks, which reported a soft third quarter on the back of weak macroeconomic environment and also infra-related issues where there was track laying taking place in the NCR region, as a result of which the volumes of the company, the overall volumes of the company, have fallen about 12.5%. And for the first 9 months itself, we've seen a decline for the company's volumes. Prem Kishan Gupta, who's the managing director of the company, joins in now. Thanks a lot, Mr. Gupta, for joining in. You said that volumes in the third quarter were impacted by the NCR upgradation and macroeconomic situations. Just wanted to know, have part of that track upgradation problem solved? And what is your volume outlook for this entire year and the next one?
Good morning, Manglam. Regarding the track work, this track work was undertaken in December, and it affected the movement from our Garhi Harsru to our other terminals like Sahnewal, Kashipur, and Faridabad. So this track work is now completed, and it will help us in faster time lines. It will the trains will run faster on these routes, whereby it is avoiding the congested route of Delhi.
Okay.
So the macros have hit us on the export side because the consumption story of India remains intact and the imports are increasing. But exports have taken a big hit in this Q3. And we have seen some early shoots in the current month, but we cannot say for sure how the rest of the world, the slowdown in the West or the COVID situation and now the festival time in China would affect the volumes.
Okay.
But we are very much on the way. And see, our rail volumes are and the revenue are almost flat if you compare. But the CFS volumes and revenue seems to be down because this quarter we don't have, compared to last year, Punjab Conveyor volumes which were about 10,000 TUs per month and corresponding revenue. But if you look at the bottom line, the PBT is much better because
Okay. Right. Mr. Gupta, apologies for interrupting you, but we're a little short on time. So let's get a couple of numbers going, right? The rake issue is sorted out. There's pressure from exports, but domestic story sounds good. So what is the volume outlook that you could give us for FY24? That is on both your divisions, the CFS as well as the railway business. and also the EBITDA per TEU. You know, you were guiding for around 6,000 earlier. For the past quarter, I think it was the mid 5,500 odd or 5,400. What is the outlook on that front? So volumes and EBITDA per TEU. Go ahead, sir.
See, for FY24, we will definitely be looking for higher volumes, because one is that we have added Kashipur terminal and it is running for in full steam. And at the end of the calendar year, we will be adding Dhanakya, which is Jaipur ICD. So overall, our volumes growth will be there. I cannot give you a number, but it will be in double digit if you look at it.
In both the divisions?
No, CFS would remain flat.
Okay.
It is the rail going to perform better.
And EBITDA per TEU?
EBITDA per TEU, the blended EBITDA will be close to 5,500, but on the rail side, it will be close to 10,000, whereas on the CFS side, it will be around 2,000.
All right. You know, on the Kashipur terminal itself, you said that you will accrue higher revenues starting from fourth quarter, because now you will get revenues of all the entire chain as against earlier. So what kind of revenues are you anticipating from the Kashipur terminal in the fourth quarter and next year as it normalizes?
See, in Kashipur, we are looking at 2,500 TEUs to 3,000 TEUs per month starting from January, because this will be the full first quarter that we will be running the full operations. And the average revenue per TEU is about 40,000. So we'll be it will add to the revenue to the extent of 30 crores.
And what about the Jaipur ICD? I mean, when it comes on board in the third quarter, what is the incremental revenue expected from that?
See, Jaipur will be a greenfield project. So basically, we will have to start from the base. And we will have only one quarter of the FY24. So we don't expect much in that quarter, but going again into FY25, we expect the volumes on an average of 2,000 to 3,000 TEUs from that terminal.
Okay, all right. What about, how is your balance sheet looking, sir? I think your debt has come down all the way to around 350 crores. You have some, expansions that are underway as well. So will you be debt free in the next year?
No, we won't be debt free, but we are borrowing less for our new terminals, as in Kashipur also. We have borrowed only 60 crores. And for Jaipur terminal, so far we have made a capex of 40 crores without borrowing anything. So we will be using our cash in hand to finance these new projects. And if any new project comes in, we might have to go for some more borrowings.
And the two terminals that you're looking to set up by 2025, have you decided on how they will be? How much will the capex entail?
It is not decided, but the capex will be in the range of 200 crores for two terminals.
200 crores for two terminals. You also own Snowman Logistics partially. So do you want to sell that and fund the capex for 200 crores? Because the stake that you have in Snowman Logistics is worth around what, 240, 250 crores?
No, we won't like to sell Snowman now, because there was a time when we needed cash, but now that stage is over. And Snowman as a company is doing very well. You must have seen the results announced yesterday. So we see no point in selling a company which is doing well and which promises well in the future.
All right. Thank you so much for joining in and giving us your views on the business and clarifying that you will not be selling Snowman Logistics, and 200 crore capex is what you're looking at. With that, we'll slip into a short break, but as we do that, here's time for the CNBC-TV18 budget quiz. Remember, there are prizes to be won every day. We gave you the question at 9:14 today, but in case you missed it, here's the question once again. When did Nirmala Sitharaman present her first budget? Your options are February 1st, 2018, February 1st, 2019, July 5th, 2019, February 1, 2020. An interesting question. Send us your answers on Twitter. Post them as a comment on the question tweet at CNBC-TV18 News. Use the hashtag budget with CNBC-TV18. Now hurry and send us your answers. Remember, we will announce the winner at 3 p.m. today.
Welcome back. Well, it's not looking good at all. We're down closer to 200 points as we speak. And keep in mind, we're getting into an expiry, that'll play out in the next few hours. When you have the markets down, the bulls are going to be caught on the wrong side. So I don't know whether or not we can see a bit of a relief rally. We'll require some bit of a trigger. For the time being, it's looking quite bleak. Just pull up the advanced decline ratio. Now, that'll tell you the picture. The number of stocks that are advancing are nearly around 2,500. declining, that is 2,500, and advancing is just around 500. So the ratio is 5:1. And stock like Ambuja Cements, now it's down close to around 9%. Indus Stars, well, it started off with a cut of around 5%. It almost moved into the green. That's down again another 5% odd. And Bank of Baroda, Canara Bank, some of these companies, these banking names have made big wealth. There is some money being taken off the table as we speak, so just keep an eye out on that front. But we've completely run out of time on this edition of Chartbusters. You stay with us. Trading Hour comes up next.